Tom Hougaard on the line here today. Tom, how are you?
I'm good, thank you. How are you?
I'm very good. I have posted your chart number 1. You want to tell the folks the why we're doing this morning and the sequence of events, and we'll just, whenever you want me to move a chart, just tell me and I'll pull it up. So go right ahead, my friend.
Okay. The reason why I wanted to post this chart to your listeners was because I thought that it was very time relevant. So if your listeners are looking at chart number 1 now, there's a little bit of a story here. So you just caught me off when you have to go to a commercial break. But I wanted to ask the viewers, when they see these pointed arrows, they mark sometimes in the Dow Jones index history that is that's associated with an extreme emotional fear or extreme emotional greed. And what we're seeing at point 1 is the low of 1998 and then the high of 2000, which was the high for quite a number of years, I think until 2006. And then we have a secondary high in 2001, and then we have the bear market low in 2002. And then we have a double top at point number 5 on the 17th of February 2003. Now, all of these 5 points have something in common, and that's the question. So if you then go to chart number 2.
Okay. Just give me a second here. We have it up right now, and it is up.
Okay, so the difference between point number 1 and point number 2 was 72 weeks or 500 calendar days, plus minus a day or two on either side. And when I sat and looked at this in 2001, I was thinking, I wonder if this is just a coincidence, because at that point I only had point 1, point 2, and point 3 available to me. But I did some sort of just a little bit of abstract thinking, sort of thinking, well, if there's 72 weeks from point 1 to point 2, and if there's 72 weeks from point 2 to point 3, and you'll be able to see that if you move on to chart number 3.
Okay. It's up.
Okay. So if you look at chart number 3, you will now see that between point 1 and point 2, there's 500 days. And between point 2 and point 3, there's 500 days. And you have to remember, I was sitting looking at this at some point in 2001, late 2001, thinking, I wonder if there's going to be a significant high or low 500 days ahead from point number 3. And that would have pointed to around the 9th to the 11th of October 2002. And so I took a shot at it because the market was declining very rapidly in late 2002, and I started buying shares for my pension, my portfolio. And the low came in pretty much on time. So now, of course, I was full of enthusiasm for this thing that I had discovered. So I at that point in time, I was often on Bloomberg and CNBC and CNN. So I marched on all the TV stations, a little bit youthful and full of exuberance, and I proclaimed that there was going to be a major top in the stock market around 0.5. I didn't say 0.5. I said I believe that the high is going to be on the 17th of February, 2003. And of course, 2004. And so, of course, when a guest comes on the air and is very specific about being a date, people pay attention to that. And that's kind of, I've never really disclosed to anyone how I did it. But as you can see, if you go to chart number 4.
Okay, here we go. This is incredibly interesting, Thomas. Go ahead.
Well, and then, look, if someone goes on TV and says that they expect a turn at a certain date, you think, how on earth are they doing that? But as now I am revealing the truth, you can see that it isn't terribly complicated. So if you move on to chart number 5, now chart number 4 shows how I projected the turn on the 10th of October 2002, because this too was 72 weeks from point number 3. So while you go on to chart number 5, I can then perhaps talk very briefly about the significance of 72 weeks, which some people would argue would be half a Fibonacci cycle of 144 weeks.
Wow.
And And then chart number 5 basically just shows that I added 500 days or 72 weeks from the low of the bear market in 2002. And while it doesn't look like much on the chart, that high that we made on the 17th of February actually held the market in keep for the next 8 to 9 months until it was surpassed in late October 2000 and 2003. So, 2004. So if you then move on to chart number 6, because then we're moving up towards something that I find incredibly interesting. From the low of 2002 up until the high in 2007, there weren't that many cycle turns, but there was one very interesting one, and that was the high. The high from the mid-2005 until the final bull market top in 2007 was also 72 weeks. But what I find incredibly interesting was the length of the bull market top to the bear market low in 2009. Guess how many weeks that was? And you get the answer if you press on to chart number 7.
Okay. I get the answer if I press on the chart number 7, and the answer is, boys and girls, as we open the envelope, 72 weeks. Now,
if you ask me why this happens, I can't answer that. But if you go on to chart number 8, I just want to very quickly show you the amount of times that it happened over the ensuing 7 years. And then if you then go to chart number 9, which is the last one, which is really the moral of the story.
Okay, we got it up here. There we go.
I'm no wise man. I'm no sage. I guess my strength lies in being able to observe. And I observed this. And the reason why I wanted your listeners to be aware of this phenomenon was because the last high that we had in 2018 is exactly 72 weeks this week in the Dow Jones Index. So the moral of the story, whether you use this or not, well, that is up to the individual. But I observed this in 2001, and I traded it in 2002 and 3, but especially in 2009, and I made a significant amount of return on my account. Now, I also, as I write, I admit there are times when this cycle seems to disappear, and I don't know why it does that. All I wanted you two and your listeners to be aware of that this is what's happening right now, not after the fact. So now we can see how story unfolds. It may turn out to be a significant high. I may get this horribly wrong. Only time can tell.
What would be your indication that you were wrong, Tom?
The indication would be if we, after this week, continues above where we are right now, then from the prior observations where I have got it wrong, because there was a couple of times where I got it wrong. Of course, I didn't show you that, because then that would kind of steal a little bit of my thunder if I showed you where I was wrong. But the times that I have been wrong is if the market takes out the high, and in particular closes above the high that we saw last week.
Hey, listen, my friend, can you stay with us till the break? We have one question. Okay, we're back, folks. Tom, we have a question for one of our listeners. How do you go about deciding when the next low will be?
Okay, so when you're dealing with what I call leverage trading, which I am allowed to do here in Europe, I'm not so sure that you are allowed to do it to the same extent in the Americas. You obviously need to operate with some kind of stop loss. But if I was going to trade this particular cycle as I've shown it today, I would probably do it with options. I'm not an expert in options, so please don't ask me what strike price, etc. I would do. But if history is anything to go by, then we would expect at least a 3-month pullback in stock indices. Now, I find that a little difficult to imagine in an election year, because the election cycle tells us that election years tend to be strong. They're not always strong. Just look at 2008, but they tend to be strong. And the alternative would be perhaps to pre-play it using an ETF. But timing-wise, that's the one problem that I have always had with this, is that I don't know if the cycle that I'm showing you here goes from high to high, or high to low, or low to high, or low to low even. Mm-hmm. It's very good at picking highs or lows, and it sure does seem like that this would be a great top in the market. It would timing-wise, February is not a bad month to make a top in the market. But as for what strike price I would trade, or how long this correction, if at all, it comes, I'm afraid that my crystal ball is out for repair. And what you've seen, what I've shown you today, is the extent of my crystal ball vision.
It's good enough. Your crystal ball is pretty good. Hey, thank you so much for these wonderful charts. And if someone requests them, is it okay if I send them out to the folks?
Yes, of course. Please do.
Okay, and
Please
we'll have you on. Yeah, we'll have you on again soon to get back to your trading, and hopefully we'll have you on very, very soon. Thank you, Tom, for being on.
Thank you, Larry.
You bet.
Bye-bye.
Trader Tom, folks, telegram.com if you want to go to watch him. But anyway, this is what we're looking at today. A lot of good charts. If you do want these charts, drop me an email and I'll